Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering 5 Dividend Aristocrats that are currently down and could be great potential buys right now. Now, what is a Dividend Aristocrat? It's essentially a company that has increased dividends for 25 years straight or longer. So this could be a great buying opportunity. I scanned through about 50 different companies. These were 5 of them that have a yield over price right now. They have some good revenue, free cash flow, and net income over the last 5 years, and they're sitting pretty well right now. So we're going to be covering what the companies are and a little bit about them. So Clorox, of course, they've been employed since 1922. They have between 8 to 9,000 employees, and they've been pretty well dominant in as far as like cleaning products. So if you go to retailers, they've really positioned themselves to be right there. If you go into just about any store that sells cleaning products, you're going to see Clorox right there on the shelf, and they've really positioned themselves for just about anyone out there that's looking to clean their bathroom, or they have a variety of products. So anyways, Clorox here, if we pull up their dividend and price for the year, they're sitting at a yield of 2.54 and a price of $130. There would have only been a couple entry points where you would have got $130. It would have been back in November of sometime, and then right around February of 2017. If you take a look at the 5-year chart, you'll see here that this yield, it comes up every so often, but then it does continue to grow. The price, these pullbacks, they're very short term, and then they just begin going back the other way. So this is for you guys to kind of do a little bit further research. If you just want to take a look at just their dividend history, we'll go max and pull in their dividend here. They have had a ginormous history of paying out dividends, more than 25 years there. We can also throw in their revenue, free cash flow, and net income over the last, we'll say, 3 years, and just look at the increase here by percentage wise. They're up revenue 6%, free cash flow, they're a little bit down the free cash flow, that they may have done some acquisitions there, and their net income is up 20.86%. So definitely well worth it to take a better look at this company. Their price to book value here is at pretty 28.51, but it's pretty, if you look at their 10-year price to book value where it's normally been at, this is one of the lower points here in comparison to the history of the company. And then you have their PE ratio, which is at a 24.11, and their future, which is a 22.78. So overall, just looking at the price and yield, this could be a great buying opportunity for Clorox now that the yield is exceeding the price. Number 2 is Kimberly Clark. They've been a company since back in 1928. They manufacture tissue, personal care, healthcare products, and some of the brands that they are well known for are Huggies, which are basically diapers. Who doesn't need diapers if you're a parent out there? And my kid's 2, and he's kind of going through. Yeah, okay. Anyways, Kleenex, and they have I believe a couple other really famous brands like Scott or Viva and stuff like that. So they are very well known. Kimberly Clark, they're mainly just kind of known for their tissues, a Kleenex brand, but right now they're currently sitting at a 3.34% yield. Now it is, you can see here, just in the year alone, they have had a lot of buying opportunities. You're not getting this at the highest dividend yield. The highest would have been roughly a 3.45, right around there back in November of 2017. If anybody did purchase that during that time, you got a great buying opportunity, a really high yield in comparison to anywhere in its past, nearly 5 years since it's been around this high of a yield. So great buying opportunity there. If we take a look at its free cash flow, net income over the last 3 years, we'll take a look that they are positive in their net income. They're up 124%, free cash flow up 71%, and their revenue, while declining, their net income has been increasing. So that's something to look at there. Taking a look at their PE ratio and their price to book ratio, their currently price to book value is at a 64.87. I'm not sure how accurate these charts are, but that would seem a little bit high for the price to book value of what this company would actually be worth. Now, PE ratio is at an 18.13, so not too high in comparison to the S&P 500, and they're expected to go down to roughly a 16.64. It's a very consumer-heavy company, tissue. They do a lot of sales in their Kleenex. Number 3, we have Leggett and Platt. So price and yield there. Leggett and Platt, they manufacture and conceive, design, and produce a range of products for homes, offices, and automobiles. They operate in different segments. 4 of them are residential furnishing, commercial products, industrial materials, and then some specialized products. And they've been in business back since 1901, and they employ roughly 21,000 employees or more. So very big company, well known. They're currently sitting at a yield of 3.15. So looking at this 3-year chart, you can see the last opportunity you would have got to buy into the stock with a 3% yield would have been back in January of 2016. So this could be another one to consider adding to your portfolio during this current downtime in the market. Now bringing in, let's bring them back in, bringing in their revenue, free cash flow, and net income as a percentage wise over the last 5 years. They're up in their net income 95%, revenue up 6.47, and their free cash flow is currently down around 20%. But over the long term, over the short term, it does appear to be kind of growing. Free cash flow, that's something you'd want to look into their 10Ks. If their free cash flow is in the negative, what kind of acquisitions have they been doing? Where have they been investing their money, etc. So something to consider. Price to book value and PE ratio here. Price to book is at a 5.0. PE is at an 18.39. Forward PE is roughly at a 16.28. So pretty good looking company there as well. And here, if we just want to pop in these dividends here for just the max, look at this time, 25 years of increased dividends, huge spike here back in 2008, where most companies cut their dividend, they spike their dividend up. Let's take a look at Clorox again here. Again, 2008 spiked their dividend up right around that time frame. Kimberly Clark, very nice, consistent, steady dividend increases. Okay, number 4, we have Procter Gamble pulling up their price and dividend there for the year. Now, Procter Gamble, they're one of the world's largest consumer product companies. They operate under 5 different segments. They have beauty, grooming, healthcare, fabric and home care, and baby and family care. So they have a wide variety of products, including Pampers, Tide, Bounty. Everyone doing that, what's it called, the Tide Challenge. This is Procter & Gamble. I know a lot of people in the Facebook groups are like, do you think Procter & Gamble could get some bad publicity or they would get sued over this? And everyone in the comments were like, do you think this is pretty good publicity for them? And that's increasing sales right there. They also have Gillette, and they have a wide selection of products. So right now, you can see their yield right now for the year is at a 3.27%. Procter & Gamble has been in business since 1905, and I believe they've been paying dividends for roughly 60 years or more. So very well-known company. They employ over 95,000 employees, and they're just they're looking like a great buying opportunity right now. That's why I'm doing this video. Over the last 3 years, when's the last time we would have got a yield of 3.27? It would have been back in early year 2016, right around that June timeframe. You would have got a yield of around 3.27, but from that point on, this stock has been rocking on. So revenue, free cash flow, net income over the last 3 years, take it at a percentage wise, they're up, and their net income huge, 117%. Their revenue has been declining, but their net income has been inclining. Free cash flow is slightly down. How are they over the last 10 years? Net income is up 26% over the last 10 years. So these metrics right here, this isn't, I wouldn't take this and be like, oh no, they're going down in revenue or free cash flow. This is just a good visual idea to kind of go back through their 10Ks, take a look at where they use this cash during this time frame. So 2008 recession, maybe they had to dig into their free cash flow, then they kind of held some along there through the recession, and then they're like, okay, we can make some acquisitions again. There's a bunch of companies that are on sales and brands, so they bought, different brands or companies and such, and spent some of that free cash flow. So that's why you want to take a look at their 10Ks and go back 10 years on these Dividend Aristocrats. So that is number 4. Let's take a look at their PE ratio, price to book value. So price to book right now, it is sitting at a 3.9. Let's take a look at the year. So 3.9 is pretty standard for this company here, for Procter Gamble. Its PE ratio, its price to earnings, is slightly higher. They did jump up in January 2018, but they are coming back down, so maybe they didn't have very good earnings this year. Maybe their last report wasn't to where it had been expected, so that caused their PE to jump up there. Forward PE is expected at a 20.05, so good future there. Procter & Gamble is always a great stock. This is just a great buying opportunity with a yield of over 3.25% right now. And number 5 for you guys, we have Walgreens here. So Walgreens, it's a leading drugstore chain with a network of approximately 10,000 stores in the US. They've been a company since back in 1909, and they employ over 345,000 employees. So huge company here. And of course, they sell a lot of prescription drugs throughout different networks and drugstores. They do in-store and worksite health centers, home care facilities, you name it, they have it. So prescription drug sales account for over 60% of Walgreens annual sales. So that's a lot of drugs right there. So the last time, this is a good buying opportunity. It's not as high as, say, November of 2017, but right now, if you're looking for an entry point into Walgreens, this is a pretty good entry point in comparison to some of the other stocks that are out there. So you're getting a 2.11 yield. Over the long term, the last time you would have got a yield during this, you can see here the yield shot up here pretty recently over that 2%, whereas anywhere between 2015 and now you wouldn't have had an entry point into the stock with over a 2% yield. So this could be a good buying opportunity over the long term. Look at this price. During recessions, these are all very recession proof stocks. I'm going to go ahead and show you the prices here in just a minute. And let's go ahead and take a look at their price to book, actually their revenue, free cash flow, net income over the last 3 years as a percentage. So free cash flow up 43%, revenue up 16%, net income down a little over 3% over the last 3 years. So that's not too bad. Net income down maybe 1% per year. So it could be due to just other competition jumping in. I know there was CVS. They had an acquisition. They acquired, I think, some other small company. Announcements of Amazon, JP Morgan, Berkshire Hathaway trying to create their own healthcare company. So this could go and affect Walgreens, or it could be one of those ones. If you look up right now, Amazon buy Walgreens, there's a lot of news out there that it could be a great buying opportunity for Amazon to buy Walgreens. I don't know if I would see it happening, but Amazon has been known to just kind of throw money out there and buy up Whole Foods and all sorts of other stuff. So let's see here. We took that there. Let's move back down. Price to book, PE ratio forward. So price to book value is at a 2.81. So as a value investors, you're looking for anything under a 3. This could be a good value buy. PE ratio is at a 20.32, and their expected future is at a 12.73. So that's a huge difference there. That's a difference of 8. So they're expected to have some really good earnings in the future, which could potentially increase decrease their PE ratio by quite a bit. So that means that their earnings in comparison to their price are going to be at a much better level, which will cause their actual PE level, price in comparison to earnings, that'll cause it to decrease there to 12.73. So again, just kind of taking a look over the last, we'll take a look at the max history for these companies. You can see that during the recessions, 2000, Walgreens, was it phased? Barely. It jumped up and kind of continued, and now we're reaching new highs. Procter Gamble, did it get affected by any sort of recessions? There was a big pullback back in 2000. They did recover there. Took about 4 years, 5 years for them to recover, but then they've just been kind of chugging along. So these are great buy and hold stocks for the long term. Again, 2000 here, not too bad of a hit. 2008, they recovered that 2008 one without ease. They recovered with very quickly and continued chugging along. Kimberly Clark, I believe this one wasn't really affected too much at all. 2000, that was that whole tech thing, not even phase them, didn't even phase them. 2008 phased them for roughly 2 years there. Then they recovered it, and all that time you would have been getting dividends. They would have been increasing dividends, so depending on your percentage wise, and if you would have been down and held any of these stocks during the downturn while they're paying you out and increasing dividends, and you're buying back those shares, you're averaging down, you would definitely be building up a very nice little dividend snowball effect. So here's Clorox. 2000, it did affect them for roughly 5 years, but they recovered during this period. If you had just invested more during this downturn in their company, you would have been able to average down in your position. You would have been able to get a yield on cost that was higher than anything prior, and they would have been increasing dividends and paying you out those dividends to be able to reinvest. So they recovered it within a 5-year time frame, and then 2008, they didn't phase them. They didn't, just a small blip, and then it just kind of continued dragging on there. So those are the 5 stocks. I hope that this video kind of helped you guys out. I think as a dividend investor, there's so many great buying opportunities out there right now. Procter & Gamble looks like a great buying opportunity. You can see that yield right now is over 3, and that's pretty unusual besides a couple high points here. So if you're looking to add and get into any of these 5 stocks, Clorox, Kimberly Clark, Leggett and Platt, Procter Gamble, Walgreens, take a look at them, go through their 10Ks, look at their balance sheet, look where they've been spending their free cash flow, what kind of acquisitions do they have, what kind of risk do they have. Is someone going to come in like Amazon, announce that they're opening up a healthcare, and it's going to tumble them down? So that is it for this video. Hopefully you guys have found it entertaining. Let me know if you guys are going to be checking out any of these 5 stocks in the future, and then let me know in the comments below if you end up purchasing anything. So that is basically it for this video. So of course, I do want to thank you guys for staying around, watching the video. If you did like the video, hit the like button below. If you're a brand new subscriber, or if you are a brand new viewer to my channel, hit the subscribe button below, hit the like button. I really appreciate it. If you have any questions about anything that was covered in this video, go ahead and leave me a comment below. I always respond back to your guys' comments. And of course, as a friendly disclaimer, I am not a financial advisor or tax professional. The information provided is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor trying to help others make their money work for them. So I think these are all great buying opportunities. It's up to you guys to do a little bit more research and see if any of these are great buying opportunities for your portfolio. So thank you guys for tuning in. I will see you next time. Have a great day. Bye-bye.